We say I'm going to take a few minutes to take a quick tour around the world in some interesting markets, and interesting in a couple of senses. That one, a lot of the dynamic markets of the world, the most successful economies are energy-based, and we'll see where things are happening from energy position. It's not just the Middle East. There's lots of places in the world that are being fueled by energy-based economies. And then we look at some interesting things in what I would consider surprising secondary markets, where exciting things are happening beyond the norm of what you might expect, and areas that, again, have not been as severely impacted. You might not know what we're talking about when we say that we're entering into a recession. But Sioux City, Iowa is a great example. They're experiencing a financial boom from growth in ethanol and biodiesel. Innovative renewable energy is now starting a $100 million biodiesel plant, and Green Plant Farms just finished a $40 million organic soybean processing plant. General Biotech of Korea and Nutriflow Biotech are now building their first soy fermentation plant in the U.S. And work is underway on a $400 billion expansion of beef products facility. On top of this is a game changer for that city if this does come about. Hyperion Energy of Dallas has optioned 10,000 acres of land to build a $10 billion, 400,000 barrel a day oil refinery. If this project goes through, it will be the second largest construction project in the United States, at 14,000 jobs and $1.4 billion to the annual economy. A small town. That impacts a pretty big region in the United States. Another interesting spot is southeast Idaho, where the energy and agribusiness, as well as tourism, medical technologies, and education are fueling job growth. Unemployment is just 3.5%, and Areva, the big energy company, the group has just announced plans to build a $2 billion uranium enrichment plant in Idaho Falls, scheduled for completion in 2014. This is on top of being home base to the state's premier health research institute, the Idaho National Laboratory. And it's got a series of inland ports which make it the center for potatoes, wheat, barley, other crops to create biofuels, distilled spirits, malt, and potato products to generate a vibrant local economy. In other parts of that region of the country, whether Omaha or Spokane or Sioux Falls or Boise or Salt Lake, again, they're fairly isolated from some of the challenges in the financial markets and the impact that the manufacturing industry is feeling in Ohio or Michigan. Another part, an interesting place, Oklahoma City, just rated the #1 recession-proof city by Forbes magazine. Oklahoma City claims per capita income of 107% of the national average, and a cost of living of 93%, with a 14% spread. Makes it a good place to be and a great place to grow up and raise your family, as well as to find jobs. Similar stories are throughout Oklahoma and Tulsa, as well as much of Texas. The story in Texas is more than just oil and the strength of Houston and Dallas and the energy markets. It's the base of trade between the U.S. and Mexico, and the opportunity that was created when NAFTA was enabled 10 years ago. The El Paso, McAllen, San Antonio regions, this Rio Grande Valley, is one of the top 10 ports, actually it's number 6 port of entry for U.S. Trade between Mexico, and represents over $33 billion worth of cross-border activity. You look at the region as a success story. Their unemployment rates dropped from 18.4% when NAFTA was brought in to 7.6% today, and it continues to grow. And San Antonio now is the 3rd fastest growing city in the country. And again, another one of the most recession-proof cities in America. Substantial impact in Chattanooga, not a place you'd think of often as a top place to go, but I was talking to one of the delegates at dinner last night. They're looking for some of the game-changing types of decisions that are made that impact the region and create opportunities for others to come in and start to buy land or invest in property or to locate themselves. But when a company like Volkswagen decides to open a plant, it's a big regional impact. They've now decided to locate in Chattanooga, acquiring 1,300 acres and planning to build a nearly 2 million square foot plant to create over 2,000 direct jobs and 9,500 indirect jobs. It's going to change not just that part of Tennessee, but it'll ripple throughout the Southeast, creating lots of opportunities for all the suppliers, as well as the general economy to support retail and everything that goes with job creation. Charleston, West Virginia is another small regional market that was not the one that was one of the more vibrant in the recent past, but with their vast natural resources, coal, oil, and healthcare and chemical industries are really feeling a strong benefit from some of the changes in the energy market globally. Charlotte's one that's a question mark right now, one of the most successful markets over the past 10 to 20 years, and emerged Southeast leader, has had incredible success, with over 8,500 companies entering the market just in the past 10 years. But when two of their biggest anchors are involved in transactions, Merrill Lynch with Bank of America and Wachovia at Wells Fargo, the question is, will they remain in that base, and will they continue to stay put in Charlotte, or do they move to San Francisco and New York and create a vacuum and avoid the market? There's a lot of challenge here, but again, even with the substantial job losses in Southern California, the vacancy rates were very tight. The markets were exceedingly strong on the commercial side prior to this window, and we expect the problem to hit here a little bit harder than most, because even with the strong base, the economic impact of job losses will be a little bit higher here than in other areas, but the support from global trade on the industrial side will mitigate that to an extent, and the port business, the port strength both in LA and Long Beach, and the inland ports along the way through the rest of the country will bode well for California longer term, but in the short term, next year, it's going to be some more pain in Southern California for sure. New York, Manhattan, as I mentioned, had seen a substantial spike over the past few years. Rental rates were growing 20% per year on compounded over the past 3 years, growing from a staggering, what would seem to be staggering amount at the beginning when it broke 100. It never went back. When it went from $65, it broke 100. Everyone thought that was a new peak and would last for a while. But within a year, to get over $200 a square foot, it seemed like there was no price that was too high. Landlords mid-negotiation would raise the price because they had more people standing in line. So a hedge fund didn't care. They were making so much money, and the law firms didn't care. They were making too much money. They would pay whatever they needed to be at the prime Park Avenue address in Manhattan. But that's not the case anymore. A lot of those companies are consolidated now or gone. The landlords are coming down to earth. We expect a significant fallout, and we have already seen new concession packages, free rent packages, higher tenant improvement packages, and not a bidding war for the space, but in fact, landlords calling you back after you might have toured the space to actually invite you for lunch or a negotiation rather than not worrying about it. But it's a huge market, 450 million square feet of space in Manhattan, and only 2 million square feet of space being built right now. Speculative. There's no new space coming on the market, and a very vibrant economy that, even after the Wall Street mess clears itself up and jobs are gone and the sublet space is put on the market, it doesn't push vacancies into an unreasonable spot. They'll go from about 5.5% at their low to maybe 12, 13% at their peak, which is pretty healthy in most markets. And we expect, again, the crossroads of job growth in 2 to 3 years coming back, and no new supply until 2014, 2015 in the market, to create a window of time where rents again will spike and opportunities will be created. I'll take a little bit of a quick tour around the world, then wrap up, and we're starting to run off here. The story of globally, again, is energy hotspots. You look at Canada. Western Canada is a boom town. Brazil is one. You looked at the world a few weeks ago and tried to figure out where things are still going from. The sort of the flow was east to west, didn't go north to south. We just went from the U.S. to Europe to Asia with a swath of pain where markets rippled and challenged each other because that's where the trade was going. But the energy markets weren't impacted like that. So Canada stayed strong, Latin America stayed strong. They weren't as over-levered as some of the other markets. They had strong domestic economies that were fueled internally and able to maintain their vibrance, and still do, particularly in Latin America, and not been nearly as severely impacted as these other global markets. Russia was going strong until the war in Georgia, then they hit the wall. Their market collapsed after that. Central Asia, a place like Kazakhstan with huge oil reserves, just emerging from the Soviet era, sort of an archaic economy and infrastructure, was building everything and fueling a very strong and dynamic market. Brazil, the story is oil, and it's not the only driver, but it's Latin America's largest economy. It's vast natural resources, and again, didn't get overburdened with debt. It has tamed inflation now, and it's managed these finances to attain an investment-grade status. So Brazil's come a long way in a short period of time. 10 years ago, you wouldn't have wanted to invest there. Now, it's one of the top destinations for foreign direct investment in the world, and it has very tight markets, virtually no world-class space. So there's a lot of money still coming in to build a type of inventory of property on the industrial side, the office and retail side, to support global corporations. India, once again, here, it's not at its peak, but it's not far off. They've overbuilt it. There was so much money that came into the market so quickly that the markets have been overbuilt to a large extent, and rents are expected to drop in the suburban parts. But in Mumbai and Delhi, they have rental rates approaching Manhattan levels and London levels. You wouldn't think of that. You don't think of India as a prime office center, but there was so much demand for so little space. Again, very little high-quality space, and put a sort of a super spike into the rental rates there to prime offices. Jobs are still being created at a record, near record pace, with Tata and others creating a new car line and fueling the region, and finding a vast new middle class to buy virtually any type of product that they can put out. Russia, as I mentioned, didn't speed up with the war in the middle of the year. They had been very vibrant. They needed to build everything again, and they were sort of becoming comfortable for the European investors primarily to invest in, and there was a lot of money building the economy. They had a very low supply and yields on property that were competing with London and New York. In a market as risky as that, to find yields at that level didn't make any sense. There's now an adjustment taking place, and very little liquidity in the market that will create, again, more opportunities for people to come back into a vast open market for global trade. China, the story's been told so many times about China and how much and how far there is to go, but some of the metrics I think are interesting, with very low vacancy rates, and even at the pace that space is coming online, it's nowhere near, for the size of cities that China has, it's nowhere near the standard of other cities. So they have a long way to go, many years to go, of building as fast as they can to try to catch up. Look at the Beijing market has an equivalent amount of space as Frankfurt, a city, with a tenth of its size, not even close in comparison. Equal size markets for inventory. So to get to Manhattan level and beyond, where it should be, it still has many years of development left before it will begin to achieve that. So China itself is still, to some degree, disconnected, and its own internal economy and building, and has enough internal capital reserves and strength to fuel its economy. But Hong Kong, a little bit different story, more connected to the global economy and global trade, is feeling the impact much more severely. It rode the way up on the appreciation side, and is now starting to feel the pinch of the credit crisis to a higher degree. I guess the biggest story from a global scene is Iceland, the first country to go bankrupt through this process. Been devastated, but it was an interesting story for a while, where a lot of money was flowing out of Iceland. They were buying properties around the world, and were a unusual spot of finance because of the spread of interest rates and the money that was coming into the country. But with the currency plummeting and the type of opportunities that are there from a tourism standpoint, as well as from an energy-related standpoint, we expect once the government stabilizes it, the foreign investor and foreign tourists to come back in and take advantage of the opportunities there. The other side of Europe, Serbia, was named the City of the Future by the Financial Times. In the Balkan region, it's a re-emerging part of the world, and one that we expect to be dynamic and vibrant and to enter the EU at some point soon. And with that, significant wealth to be created for investors that are pioneering investors that are coming into the market now, just as they have in Kiev and some of the other regional markets that once we enter the EU, find yield compression and rental rate growth to start to match Western Europe economies. So it's not all we sort of started out with a storm cloud and a lot of challenges and problems that are surrounding the world, but the sun is starting to poke out. At least you know the sun's still there. It's still behind the clouds somewhere. And at some point, the new weather pattern will emerge and new opportunities will be presented. And it's really inexorable. The dynamics, just looking at the U.S., are clear. You have 15% growth expected in the United States by 2020. That's just 12 years away. Not a long time to add 45 million people to the U.S. economy. That's 17 million households, which will need 2.5, depending on how dense it's built, from a low of 2.5 to 11 million acres of land to be consumed to build and house and feed and support all of those people. Think about that. Think about Texas and New York didn't exist today. And we said in 10 years, 12 years, we could build Texas and New York. That's what has to happen. It has to happen. And it will happen. So the opportunities are there. And that's all spread out. It's maybe in Sioux Falls a little bit. It's maybe in Manhattan a lot. It's in places like Santa Fe and Yuma and warm, dry places. The research says that people want to move to and migrate to the educated markets where there's great educational facilities, where there's great healthcare facilities. They want to be by areas with outstanding transportation facilities, the centers of global hub and spoke airports, as well as on-the-ground infrastructure from a mass transit system and roadway system are the places that will attract and add the most people over the next decade or more, as we have overbuilt and overpopulated some archaic infrastructure in cities. The cities of the future will emerge in cities that are more enlightened and can put more infrastructure in place and maintain their infrastructure well to be able to help people move around. But clearly two different things happening where young people entering the workforce are wanting to be in urban centers. They want the dynamics of the culture and the lifestyle that's there. They want to be around other people with their ilk and dynamics and find those jobs. They'll go to these mega cities and mega centers and companies will follow them there. And likewise, the retirees in the beginning edge of this baby boom generation are starting to go to warmer, drier places with easy access and accessibility to find a new lifestyle and an enjoyable lifestyle for their retirement years. We've done some research and see some interesting names. The absolute growth, the cities growing the fastest in total numbers are places like Atlanta, New York, and Chicago. Once again, great airports, great culture, great job opportunities are there, and places that you wouldn't think of so much, but are cities of the future, are places where just easy lifestyle, social and relaxed, and good healthcare and a great quality of life, mainly in the South and Southwest. So opportunities are upon us. Challenges are certainly before us. There's not an easy path to great success over the next 3 to 5 years. There's a difficult path to success, but the success and the opportunities are incredible. There was a more difficult path 2 years ago. In 2006, 2007, to try to figure out what to do when prices were off the charts, where opportunities were limited, where you couldn't figure out where the next place to grow was, or how to afford to grow in a place that looked like an opportunity but didn't have a welcome mat out. Now there's welcome mats out across the landscape, not just in the States, but across the world. There's tremendous opportunity, and it's really just a matter of picking your spots, finding your opportunities, and taking advantage of them. We're very excited. It's certainly a challenge as a company and as a group and as an industry, but we're very excited about where we are with the pain behind us and for the new capital that's been amassed, the new energy that's coming to the market that we see ready to approach in 2009 and 2010. So with that, I will wrap up, and I appreciate your time and attention, and I'd be glad to answer any questions if you might have them, or otherwise get you off to your next sessions. Thank you.